The following is a presentation of TFNN. The Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour. My pleasure to be here Monday through Friday, 877-927-6648. Thank you to our great hosts earlier on. Let's try to keep that standard up. Tough to keep up. And hopefully that goes all the way through until the close today. We've got the Dow down 40 at 20,687. You've got the S&P down 120 at 2366. This is going to be very interesting. The comp index is up 1 at 59.18. But the volatility index has actually gone into the 12s as at 12.19, up 65 cents. My suspicion is that the volatility index is starting to come alive. It's starting to act quite interestingly over the last, I'd say over the last half a day going into yesterday and this morning. So we'll be watching it going into the close. The E-mini is down $1 at 23.63. Well, look what we've got here. We've got a, move this to the side. We've got peak D at 23.97.25 in the June E-mini S&P contract. It made a peak D as well as Chapman Wave 5. That's always a tip-off that we could have at least time, if not price, in the consolidation. But we have pulled back quite sharply from 23.97 down to 23.17. If I remember correctly, that was about 4% correction. A bounce, giving it's about a 50% rally. This is going to be very interesting. Why? Because if by the end of the day, when all the buying is done, which the buying is actually done yesterday and a little bit today, what I'm looking at now is repositioning, how that affects the final couple of hours. In my work, what I've looked for years is that on a weekly basis, if there is a sharp close going from Thursday down into the Friday period or even Friday, and then a negative, very negative Monday, what you've set in place is the chance for the weekly to make a peak. It turns out that this is also the monthly. So now what we're going to do, let's just do this step by step. The stochastic is rallying, but it's still only at 54%. And the MACD is rallying, but it hasn't crossed positively. And the histogram has not gone positive. It's still at minus 2.3 in the E-mini. Negative. In other words, the technicals haven't yet gone commensurately higher with the price. Prices had a very nice move, 2317.75 to yesterday's high of 2366. I would say that that's pretty darn good rally. But what's really interesting here is that 9-period moving average, that black line at 2358, 58 or 56. Let me double check. I think it's 56. What's really important here is it held today, but if by Monday we start to dip and the E-mini goes under 2353, 2352, that area, I will have all the ingredients there because the stochastic will be turning down, the MACD will be deflecting lower. At this particular point, the day is young. I don't want to over-anticipate anything. The 120-minute chart, let me show you this. 120-minute chart, making another arch formation, gone to Chapman Wave 5, but if it breaks about 2366.75 today, I'm going to have to admit that that's good. If it starts to fail and it goes to that 2355 level, that's going to 2364, that's going to say, oh man, Monday's going to be very interesting. But in the meantime, back at the ranch, holding well, technicals are not quite confirming the rally. Weekly chart, peak D, Chapman Wave 5. Let's wait until 4 o'clock before we do anything, but I will say that the question I've had for myself is, will the 2341 level be taken out on the downside by next week? which would confirm that finally the MACD is going to cross negative and the stochastic will definitely be under 83%, and that's good right now. Let's go on. The QQQ series made an all-time high yesterday. Failed to do that so far today, but what's really interesting, and this is going to be fascinating for the close, because what we're looking at here is that I have no choice right now but to call this a peak E. And I said to subscribers this morning to my opening call, I said, it'd be hard to think of this as a brand new leg A to the upside. I mean, wow. If that's the case, this market is going to scream to the upside without the consolidation continuing, which is what I've been anticipating. Now, let me just see. Now, remember that up until now, last week's candle, which had a high of 132.43 in the Qs and a low of 129.68, had a slightly lower low going to 129.40 on Monday. And thus far this week, it's gone to 132.61. Yes, great. Coincident with what I'm saying is in the den, we've got one of our tigers who knows technical analysis extremely well saying, engulfing possibility on weekly Qs. Yeah, that's an engulfing. But two things have to happen. One is you have to decisively close above the high of this week, next week, close that is. Two, you don't want to close back in more than halfway into the candle, which would be at the 131.15-ish level. So we'll be watching this. Meantime, the A, B, C, D, this is a leg D, a peak D in the 120-minute chart of the QQQ series. Let's do this now. I want to look at the IWM. Spend some time looking at the IWM, just looking. Sometimes I like to have no opinion whatsoever, just look at the darn thing and say, what are you doing? Tell me what you're doing. And what it's telling me is that the candle that we've seen this week so far, and it's up, the IWM Russell 2000 ETF, is trading at 137.49, up 23 cents. It's squeaked higher above yesterday's high, and that's 1, 2, 3, 4 fabulous candles, and today should have been a down candle, and so far it's not. So this is a good candle. This is telling me something about what's going on in the overall market, and one of the reasons, the only reason why I was all prepared today to say everything I'm looking at says we should be making an arch formation and going lower by this afternoon or tomorrow. The only three things that held me back was to say the IWM is just about to test downtrend resistance in this Chapman Wave falling axe formation in the daily. The weekly chart technicals are not that good. I want to see if it closes above the 9-period moving average in the weekly. I want to see where it closes and why. I want to see where the Qs close. That's the NASDAQ NDX 100 trading vehicle. And I want to see where the SMHs, the semiconductor index, closes. And it's kind of, it's had, in the 7990s, it's had like four, would have been almost 5 today, instances of trying to break out, and it just hasn't been able to do that. So the SMHs, the semiconductor index ETF, there's going to be a tell for me. And then the fourth one, which I was going to get to right now, and I'll get to it at this moment, is the VIX index had a really nice candle. It's kind of held that uptrend line that I made a big deal about. In fact, now what I'm going to do, because I always do that, I go for the most conservative support levels, and that's it. And it's held them all. So that's going to say where the VIX closes today is going to be very interesting, because the horrible candle on the week, the candle is above the 9-period moving average. Isn't that interesting? I'll be back. Basil Chapman, Untitled Chapter.
If you're looking to unearth a new financial resource and diversify your financial portfolio, consider the new market-safe core commodity CD from Everbank. This 5-year U.S. dollar-denominated CD gives you exposure to 4 equally weighted commodities: gold, copper, WTI oil, and sugar, in one powerful CD. With no pricing caps, you can potentially earn an unlimited upside payment at maturity if the commodities increase in value across semi-annual pricing dates. And should the opposite occur, your principal is 100% protected. Keep in mind, returns are based on CD performance. There's no annual percentage yield or periodic rate of interest on this index CD. Don't miss out. With certain commodities on the rebound, now is the time to take advantage. The March 23rd funding deadline will be here before you know it. So call 1-855-750-4051 or visit everbank.com/TFNN for the CD's term sheet and other important product details and disclosures. Once more, that's 1-855-750-4051 or visit everbank.com/TFNN. This advertisement is sponsored content. Everbank is a member FDIC.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com. The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Basil takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi everyone, Basil Chapman. This is the Tiger Technicians Hour, and we're looking at the E-mini 2-minute chart. Made a peak D, pull back, trying to form a V-shaped pattern. The MACD is trying to turn up. Stochastic's okay. We'll see if it's able to retest or even break out above the 23.65.25 level. And this is very important because the longer it holds up here, the longer we go into the late hour session, the last 2 hours of the last week, of the last month, of the last trading day of the month. So what fund managers do is going to be very important. However, within the context of the E-mini, the 10-minute chart has made a peak E in a left side, right side price time match. The MACD is flattening out, but still good. The stochastic's very weak. It's not showing any strength here. So I'm going to make the parameters 2360 on the downside, take that out, very negative. Pop to 2366, and all of a sudden you're looking at a challenge of the 2366.75 high of 1110 on the 30th. Oh, that's during the show yesterday. Huh, interesting. Okay, so that's what we're looking at. Now, let's go back to the volatility index. You'll see that the VIX index in the weekly chart is still making this, it's kind of a cup formation, slightly higher lows and higher highs in leg C, but we'll see where this closes. And the 120-minute chart is in ABC. I believe this is a peak C or leg C that we're looking at right now. Now let's get to the nitty-gritty. So VIX index at 1206. If it's able to extend this into the 1223, 1231 area by the end of the day as the market turns down quite sharply, that's going to hint that Monday could be a weekday. And if it holds very well as the VIX index at 1206 suddenly slides to 11.78. And the Dow goes actually positive for the close today, up 27 points, S&P up 2.3. I'd have to say, you know what? Buying just prevails. Amazing. Okay, let's get to other nitty-gritties. So I had a question from Paul about margin debt. What is the significance of margin debt being at record levels? The last time it was this high was 2008. What do you think? There are a couple of things. I could very glibly say margin debt is going to be an absolute killer. It always is. I mean, we know that. It's the timing that is so important. And I actually have other things that I like to put together with the margin debt. And off the top of my head, I can't even remember because I'm just totally focused on some other things right now that's going on in the market. So I can't really speak to it as coherently as I'd like. So I'm going to say that that's a great question. The answer is that it's going to absolutely impact us. But the second part of it that's most important is I want to put it together with the gross domestic product, together with the debt that I'm looking at in mortgage, the debt that I'm looking at in credit card, the debt that I'm looking at in other aspects like auto loans, etc. I need to get those figures, and I haven't had a chance. I won't be able to do it for at least for another 2 weeks, but it's a fabulous question. I want to be reminded about that question every month. My thinking is that at some point, margin debt is going to scream to the upside. In other words, people will be buying things that they can't really afford. We're way into it right now, but I think it's going to get a lot worse. This takes me to the next thing I'd never had a chance to do. I want to just do it real quickly, just on this recent trip that I had, short trip, to Israel. I've been to Israel quite a few times. Here's the, so it's actually a very beautiful city. There's tremendous growth since I was there 10, 11, I don't know when it was, maybe 10 years ago. And most importantly, is that the architecture, for me, the architecture is really nice. It's just, there's some beautiful buildings. And the buildings are just springing up in all these towns. They're more like little mini cities because they have 20, 30-story buildings very easily, 3 or 4 of them at a time. But look at this building. This is the new Tel Aviv gets Israel's first 100-floor skyscraper. Municipality approves plan for Israel's tallest building to be built next to Savidor Central Railway Station. Very nice station that we're at. But this, look at that building. Look at that shape. Look at that design. I'm not even sure what they're going to do. Is that going to be hollow in the middle? Or is there going to be a big rain? What happens if it rains heavily and you make a swimming pool from the top there? How it looks like a Y at the top. It's very unusual for a building. But the architecture there is really, I love the architecture because it's thoughtful, it's innovative. And let me talk about innovative. I was speaking to someone who works at a company, a 3D, let me put that aside, a 3D design company like 3D Systems here and SSYS, which is something that we traded a while back, Stratus Limited, which bought an Israeli company. And that person was saying, and she's in product management, and she was saying that what's very interesting is the two cultures. She was talking about, but I had already spoken about this quite a while back, and my thinking had always been that Israelis are very innovative. They like to get to products, and they like to find an easy solution to things. It might be a very complex way of finding it, but it turns out to be an easy solution, or at least something, the solution makes it easier to implement whatever it is. So she has said that it's interesting, the two cultures, because you've got this company, I think, from Minneapolis, Stratus, and then you've got the company that they took over in Israel, which is 3D printing and design. And I said to her, my impression has always been that the Israelis come in and want to innovate. They want to kind of stretch the rules as much as possible, probably sometimes even breaking rules. And I think American companies are way more conservative. She says that's exactly it. They want to stick to the letter. They want to implement protocol that's already been notated. And I thought that was just very interesting. It's one of the reasons why you park your car. There's an app that takes you. You can add to the meter while you're away from the meter. There's so many things. It's very, and there are many. I mean, I've heard from people who've flown back into Kennedy or LaGuardia or New Jersey, and from around the world, different airports, and they say, "Wow, talk about an old decrepit set of terminals and stuff." We're the third world country when it comes to some technology. So it's just very interesting. So I wanted to mention it, and I thought it's fascinating that we've got, it's a cultural thing. And the reason why I wanted to bring it up is that I look around wherever I go, as long as I can remember from the time I was maybe 4 years old, I would be interested in design. And we've got Joe in Boston. Joe, I'll be with you in a moment. I'm just finishing my thoughts. My thoughts were that fairs always are a little later in other countries. And one of the fairs I was looking at was tattoos, the buildings, cars. I'll be back straight off this Downtown 27 S&P slightly higher.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi everyone, we're back. Basil Chapman, Tiger Technicians Hour, and we're going to go straight to, from Newton to Boston, 6 miles. Hi Joe, how are you?
I'm well, Basil. How are you?
I'm well, thank you.
Good. So I called a couple weeks ago on the day of the Fed meeting and asked you about platinum.
Yes.
And, we said kind of wait. So I held off. I think it was around 90 at the time. It popped to almost 93, and now it's pulled back. So I'm wondering if you think this is a good entry point here.
So PPLT which is the, let me see, it's the physical platinum shares, ETF, trading at 90.87, has made the arch formation. It didn't make a top at that 100 level, and that's what I said. I was looking at a peak E at 100.10 on the 27th of February. Really important about this is that there's an arch formation. Now, I love this because I just did that in my looking at, was that the 1 minute chart, the 2 minute chart? Yes. So there's a trend line that I always look at, and I always chuckle because although you can put it in, there's a trend line. I'm looking at a 2 minute E-mini chart, and from the low at 2358.50 at 9:34 this morning Eastern time, there was a trend line that went to a higher low, and then as it was coming down, I said, I'm going to put this trend line in because it almost always breaks this diagonal trend line, any H pattern chart. And lo and behold, this one didn't break it. It hit it and ran up quite sharply, and now it's coming back for the fourth time. So I like to say that chart patterns repeat. It's just the chart pattern is a microcosm of human nature. That's just what we're looking at. And this particular chart has, in the weekly, it has along the very same kind of big arch formation, if you want to think of it as higher lows. And that low started off from the low that was made back in January of 2016 at 78.30. Went to a peak E, sharp pullback, well, very big rise from that from the 70s to the 110 level, pulls back sharply to the 86s, and that low of 85.31 back in the week of the 16th of December held, and it ran up, and now it's doing exactly the same thing, coming back to test that rising diagonal trend line. So on the weekly chart, my instinct is immediately to say there's an arch within an arch within a smaller arch that's forming, and the history is that it's trying to look at support levels and it's trying to hold those levels. So my instinct immediately is to say, hey, that's the weekly chart, that's the bigger tide, and the tide says we haven't yet made a low of significance. So now let me go, excuse me, let me go to the monthly chart. Monthly chart is the same thing, and the whole March candle is big in a big red candle, ugly, and it took out the low of last month, but it's trading above it, and there's that trend line. The monthly chart says, is at a critical level that the MACD is good, the stochastic is okay, but really not strong. It says for your rudder, that is for the shorter term, let's go to the daily. Now I can do a little bit more work with the daily because we talked about the chart formations. And you can see if I do a really large arch formation right there, it would continue all the way across and suggest that this little mini arch that's forming right now, even though it's a nice candle, it's gapped down today. It's down 19 cents. It's at 90.81. Even though there's an arch formation, the MACD is turning down. Stochastic's gone back to negative, and the histogram is suggesting that there's a little more work to be done. So normally I would say to you, there's just enough evidence to say, why don't you start a little position here which you can add to? I'm going to hold off. I'm going to say, I'm pleased I did this work. Yes, it could rally. And let me just quickly look at the 120-minute chart. Yep, I feel quite confident in saying, just in my work, as I look at it right now, I don't have enough evidence even to say that at 90.81, because the low that was made on the 15th of March is 89.30. Not a big deal. 89.30 is just, less than a point away. But if it takes that out on the downside, there's a lot more room left. So I'm just going to say to you, Joe, you've waited this long. I'm going to say wait a little longer. And there are two reasons. If it goes above 91.60 Monday or Tuesday, we can look at it again. And then I'm saying to you, okay, there's a chance now that it could have a little bit more of a bounce. Treat it as a bounce. Don't get carried away. You can start a position, not a big position, but you can have a position. I can give you a 1.5 point stop or a 2 point stop. That's about a 3% risk. But at this point, I'm not convinced it's done going down yet. Just there's too much evidence to say that the tide in the monthly, the tide in the weekly, and even the tide in the daily is suggesting that it's going to low tide. It isn't on its way up to high tide. So I don't think I can feel confident. And I don't think I would not be upset if you missed a point and a quarter on the upside. If I feel that the trend has more to go, it would be remiss on my part to say with an arch formation and a gap down today that I could comfortably say even nibble. I would just say hold off getting a position. And one of the reasons is if by Tuesday or Wednesday of next week it hasn't even come close to 89.30, but it's holding quite nicely, then I can say, you know what? Now you know exactly where your risk is. It would be, if it's a little bit higher, I'd say 1 penny below today's low of 90.42. But at this point, I just don't feel comfortable saying even nibble. I'm just going to say I would step aside and wait for more evidence. There are a couple of things going on. The pressure on the downside in the commodities, and this is TRCCI, the commodity index that I look at has the same kind of pattern. And you can see today it's arching over. It's down $1.21 at 416.66. And this has, it's an equal weighted commodity index. So it has platinum in it. And it's saying altogether, when I'm looking at the commodity index, it's suggesting that there's still more to go to the downside. We'll see if next week how the test of the left side low, in this case it's the low of the 9th of March, how that comes about. And I'm going to say the same thing. If I look at platinum, the continuous contract, nice candle today. I might be wrong. This could be a little bit of a bounce. But boy, it's real close to the low that was made in the 15th. Joe, I might be wrong, but I'm going to say I would hold off. There's just the weight to the downside and the type of candles that we're looking at that have been made to the downside just suggests that unless it's going to be a big breakout to the upside, and we'll be able to jump on that, I'm cautious.
Okay, thanks, Basil. I think that kind of confirms what I was thinking, so I appreciate the feedback.
Okay, well, let's look at it again next week. Thanks for calling, Joe. Joe in Boston,
thanks,
we're looking at. Have a good weekend. PPLT trading. Not sure that let me just have a look at the gold contract right here, because there was a nice bounce. See, the gold held the 200-period exponential moving average. You see, that's the continuous contract. 1241 is that 200-period moving average. That's been my target for a little while. I wanted to see how it handles the target. So far, it's bouncing off it. MACD is still okay. Stochastic is at 85%. It's also good, but is turning down. So this is going to be very important. So let's look at some of these things when we get back. We'll look at some of the commodities. So to answer Paul's question, Paul, you've stimulated my thinking about this. Let me start over the next week or two. Keep reminding me. There's nothing to do right now. But I'm going to be looking at the debt and all the different areas over the period of a couple of weeks. And then I'll make some kind of...
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foresight Fund Services, LLC.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Hi, folks. So we're back, and we're looking at the S&P just slightly higher. Now, let me do a couple of things. Had a question about Amazon. The question was, the monthly charts looked fantastic. See, when I talk about leapfrogging, and this is what happens in Israel a lot of the time, that the technology, like Mobileye, got taken over. Mobileye is an Israeli company. Everywhere you go, they have this little Mobileye on the windshield, which is measuring this and beeping that and whatever. But what's really important is that Amazon is created, excuse me, Amazon is created by leapfrogging the technology of the brick and mortar stores, is created an environment that is its own culture, its own medium, its own technological parameters. And within that context, I think that's one of the reasons why we're seeing so many of the retails. There are other reasons. I'm sure there are other reasons that I could articulate here. Don't want to take the time. But there are other reasons. But I think the most important is that Amazon is the buyer of quick resort. You want something, you just Amazon, right? And that's what's showing up in the chart. So it looks fantastic. And that's one of the reasons why the Qs have been so strong. That's number one. Number two is I've got an instant restart. So this makes it G/C. My thinking is going to turn out to be a C. It could even be a B. I'm calling it a C for now. And look at this weekly candle. It raises the base at 888 right now, up another 12. This is a leg D. Now, maybe I could, this is a brand new A. I mean, if the technicals are so good, I could call it an A. So let's just leave this for the moment. I just want to say Amazon is the reason why Walmarts and all these other stores are having a tough time. Let's go to Neil in Colorado. Neil, how are you?
I'm great, Basil. It's good to have you back.
Well, thank you.
I was wondering about Goldman Sachs, symbol GS. I'm long some stock at some lower prices from earlier this week. Looks like we bumped into a little bit of a resistance zone, although at least on a daily chart, it kind of looks like we're in a leg A or somewhere along that line. So it looks like it might be early into the move. Just wondering what your guidance might be in terms of continuing to hold it or selling it into this little move up.
So let's do this, folks. We're looking at Goldman Sachs at 230.41, down 81 cents. It had a rally that went all the way to a new all-time high. We call it, I mean, I have no choice but to call it a leg A in the monthly chart. Does everything have to go to D? Well, they usually do. But let's just say that that's an incredible leg A, going from the 138 level to the most recent high of 255.15 back on the 1st of March, speech night. And what we're really looking at is the pullback, 255 down to 220 something, $30. So what is that? So 12% correction. That's a big deal for this stock. And the monthly chart, that candle is not going to be a great candle looking into next month if we don't make a new high in March, April, in April. So this is what I'm thinking. You are in. There is a chance that we're making some kind of a bottom in the XLF. Someone had asked me about MS, which is Morgan Stanley. So I'm going to suggest to you, now you'll have to think about it because you're the one that got into the trade, and I'm not sure what whether it was just because it came down to a level you were very comfortable with, and now you wanted to finally get into Goldman Sachs. If that's the case, I'm going to make a suggestion to you that says, if you can hang on to Goldman Sachs as long as possible, in other words, I would not like to see it take out the low of 220.85 of the 27th of March. But I don't want to get you out early. If it's a trade, I could say, based on other things I'm looking at, you better be real careful, because if it doesn't go above 232 round number high that was made yesterday, if it cannot do that by Wednesday of next week, instead it's arching over and it's back down at the 227 level, got to be careful. I'm thinking that this is really a good way, because you're in it, you've got a bit of a profit. I would even say to you, if you've got enough, keep a core at the price that you got in as long as you can, and let's see if you can squeeze out as much to the upside, if it's going to give it to you, as possible. Why? Because if Goldman Sachs doesn't take out the low that was made 5 days ago on Monday, and instead is able to get deep into this ugly candle of the 21st of March, high of 243 and low of 232, if we can get into the middle of that 238 9-period moving average of the weekly chart is going to be like a magnet, and it's going to say, you know what? Goldman Sachs is in play. It's not going to break down. That's the reason why, if you can think of it as two pieces, one part you want to keep, and you've got enough to be able to say, I'm just going to keep the other part. If it takes out the high by Tuesday, if it takes out 232, I'm looking good. Or you could say, the core position that I've got must have a stop, and you put a stop in above your entry point. Give yourself a little bit of a gain, because you put your money to work, and then let some other part of it, treat it as a trading vehicle, and see how high it can go, and you raise your core position for a little while longer. And I'll tell you why. If I'm correct that we're going to arch over, and by Tuesday or Wednesday we could be looking at a weaker Dow and S&P, and the Qs finally give up some of their gains, then Goldman Sachs, this is going to be the test for the financials. Because if I look at the, I have to put this together. If you're looking at the Treasury bond yields, the 30-year, the 10-year, and the 5-year yields, the weekly yields, I've got a trading band with a limit to the upside at this particular point in the yields, meaning that bonds could rally some, but they don't have to rally much, and yields could remain in this position. If they remain fairly high and they don't break down, the financials could see some benefit. Does it make sense what I'm saying to you?
Yeah, I see what you're saying, Basil. Again, I'm looking at catalysts such as certainly interest rates going a little higher, the profit margin increasing, plus they have an earnings call sometime in the middle of April. Besides, of course, you've got whatever rulings might come out on Dodd-Frank, plus whatever else in terms of.
So you're looking at and saying there are quite a few favorable things that could unfold here, and that's really part of the impetus for getting in. I don't disagree with you. I think you're correct, except I think that rates are going to remain in a trading band, not breaking out to the upside, probably not breaking down to the downside either. That's what I'm thinking. That's why I'm saying I want to see how the financials hold up going into midweek next week, because if they're holding very well, you might have picked yourself near the bottom of a nice trading band going towards the upside. That's what I'm hoping you're going to be able to achieve. And that's why I'm saying keep a little bit of it as a trading position. Try to keep the core as long as possible. In other words, don't get scared out of the core position until it gets back close to your entry point, because there could be some upside surprises rather than downside if the financials are going to hold well, because yields are not going much lower, but they might not have to go much higher. That's really my thinking.
Understand. Thank you very much for that.
So congratulations on your entry. Let's watch it together. We'll be watching it Tuesday, Wednesday to see what happens. Thanks for calling. Have a great weekend. So, yeah, folks, I've just got a bunch of calls. We're just about to wrap up this particular section, then we're going to go to the next one. But as we do that, Caterpillar was a question. Let me look at CAT. CAT is part of this whole move that many people are thinking are going to help this particular sector where this is really the core to the growth. And Caterpillar is holding okay, but it doesn't look all that great. So I'll be back and we'll talk about the market as we get into the end part of today's Tiger Technician Zone.
Hi, I'm Steve Rhodes, host of the Trader's Edge heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Learn how to trade options with Swim Lessons. Brought to you by TD Ameritrade. Think or swim. Next on TFNN.
Hi, folks, we're back. So let me just do this. I've got a question. Dave says, morning, Basil. Help, please. I bought Oxy yesterday. Where did I go wrong? So Oxy, let me just do this real quickly, because Oxy is part of that group that we were looking at, Chevron, Exxon. These are the multinationals. Oxy isn't the greatest chart, whereas that you didn't go wrong. I don't think, how can I put this? I think the H going to an M pattern is what we're looking at. Oxy at 63.39, down 88 cents. It's really not one of the best. But, Dave, if you bought this for yields, then I'm just going to say to you, be real careful, because I don't want to see 63 to 61 is 2 points, so that's 3%. I don't want to see you give up your yield just because you're holding the stock because it's a yield stock. This is not, let me just do this, CVX. And I don't really want to tell you to get out of your stock to go into another one of these. So CVX is not that great. What I had said, Exxon is probably the better one, I said last week. But I'm not sure that these are the, how can I put this? I need evidence. That's what I'm going to say. I need evidence that these integrated oils are going to be able to find a base here from which to rally sharply. I don't want to give up yield. I don't want to give up capital for yield. It's just real simple. It's like those people who sell, who want to hold their stocks through the new year because they want to get the capital gain, and then bam, those stocks in December crash. What's the point? So I'm just going to say, Dave, put in a stop. Don't be afraid to put in a stop. If you're down a point, maybe a point and a quarter, that's not a big deal. It's a big deal if this thing drops if it goes underneath this key level of the 27th, 62.99, I would say that's a big deal. Even if it's forming a base, because you're now vulnerable to the lower lows, this H pattern, the dreaded H. So Dave, put in a stop. That's all I can say. If you got calls, that's something different. I don't think you said you bought it. So please, or even, you know what, take a little bit off now. At least give yourself some protection, especially the way that Exxon has given back such a huge move from yesterday. It's given it all back. So just be careful. That's what I'm saying. So let me wrap up here because we're going to run out of time. Then there was one other question. The Dow, yes, best quarter in 5 years, but it's in a consolidation, the longest period of consolidation in quite a while. Everything I'm looking at says, Basil, you might be right about lower lows and lower highs. That's the way I'm seeing it. All right. So here we go. If I missed some of the question, yes. The question was, why would you be looking at GS as possibly being good if XLF, if yields are stuck in a range? Surely we need a little more evidence. I'm saying absolutely. I haven't put it. It's on my list for my subscribers. We want to buy the XLF on the next big decline. It's not a big decline going from the 25.5 area to 23. It needs to get into the 22.30s to the 22.20s. That's where I really want to be looking at it. So I'm prepared to wait. Goldman Sachs, the question was, would I draw the Amazon? Let me do this for the weekend. I've got all the questions ready. If I haven't answered your question, I'll try to do it over the weekend so I compare. Monday, we'll have a continuation of this technical Chapman Wave Friday session, and we'll go into it a little bit deeper. Meantime, just keep it on your radar right now. The VIX index going into the mid-12s as the Dow gives back any of the gains, the earlier gains that it made. The Dow goes minus 65 or more. I'm looking at lower lows next week. That's just the way I'm looking at it. I am completely wrong. If anytime Monday or Tuesday or Wednesday, the Dow closes at 20,820, I'm saying, you know what? We've used up time. We're not going to use up price. This is the way I see it. That's what can I do? So, and of course, I didn't spend time. I was going to do that, showing you the Chapman Wave 1, 2, 3, 4. And we're in. I think we're going to go to 5 down in the daily chart, but we'll do that on Monday. Have a great weekend. Check out my opening call. I think you'll find it informative and hopefully beneficial and helpful and profitable. I'll be back on Monday. Have a great weekend, everyone.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN,